Welcome to today's Explainer. Today, we're unpacking a really fascinating macroeconomic mystery based on a revealing staff report from the Federal Reserve Bank of New York. We are going to trace exactly how the foundational American middle class, which has historically been the absolute bedrock of economic stability, somehow transformed into a massive economic fault line right before the 2008 financial crisis.
Let's dive into this by challenging some of our standard assumptions about economic stability. When we think of systemic financial risk, we usually picture Wall Street bankers, crazy volatile stock markets, or massive corporate failures, right? Well, the data tells a completely different story. The central mystery we're looking at today is how average, everyday households, folks right in the middle of the income distribution, actually became the primary source of aggregate financial risk in the United States.
To really grasp the scale of this shift, we need to look at this absolutely shocking statistic: 120%. That was the peak household debt-to-income ratio in the year 2010. Just to put that into perspective for a second, at the end of World War II, back in 1950, that number was sitting at a very modest 30%. So over those 6 decades, household debt grew fourfold relative to income. It's literally a mountain of debt. But the real question we have to ask is, who was doing all this borrowing?
So, let's look at part 1, the middle-class debt boom.
It's super common to just assume that rising inequality forced the poorest Americans to borrow just to survive. Or, on the flip side, that the ultra-rich were using exotic debt instruments that skewed the numbers. But when researchers dug into 7 decades of data on debt, income, and wealth, the reality totally flipped the script. Households right in the middle, between the 50th and 90th percentiles, were solely responsible for a staggering 55% of the total household debt increase between 1950 and 2007. By contrast, the bottom 50% only accounted for about 15%. So the American debt boom wasn't a story of the extreme rich or the extreme poor. It was, fundamentally, a middle-class affair.
Which brings us to our second point, the income-debt paradox.
This right here is the primary contradiction that actually confused economists for years, because the sheer volume of middle-class borrowing completely contradicts how economists expect normal, rational people to behave. If you adjust for inflation, average middle-class incomes grew by only about 25% since the 1970s. That's less than 0.5% of growth per year. It's essentially stagnant. And yet over that exact same period, the amount of debt taken on by these very same households exploded by 250%. Their debt was growing 10 times faster than their paychecks. Standard economic logic dictates that you borrow against the expectation of higher future income. You don't take on massive debt when your wages are basically flatlining.
And this leaves us with a massive puzzle. If middle-class families weren't making much more money from their day jobs, how and why were they funding this unprecedented wave of consumption? I mean, how did lenders even justify giving them the money in the first place?
Let's move to part 3 and look at how folks started treating their homes as piggy banks.
Because the answer to our puzzle doesn't lie in their paychecks at all. It lies in property, specifically a concept known as home equity extraction. Home equity borrowing accounts for roughly half of the total increase in U.S. housing debt between the 1980s and 2007. Basically, middle-class households started treating the family home like a giant brick-and-mortar ATM. Since their net worth was highly concentrated in residential real estate, any bump in house prices meant a huge bump in their overall wealth. They were literally dipping into rising paper values to keep their spending up despite those stagnant wages.
Now, even though their debt-to-income ratio was climbing fast, their net wealth-to-income ratio was booming at the exact same time. How is that possible? Well, between the mid-1970s and the mid-2000s, real, quality-adjusted house prices in the U.S. shot up by 75%. The asset side of their balance sheets was growing even faster than their liabilities, and that created a really powerful illusion of deep financial security.
And this soaring valuation is exactly why they felt so comfortable taking on all that debt. For the middle class, housing wealth-to-income ratios more than doubled, jumping from 140% to an unbelievable 300% by 2007. Price effects alone accounted for almost half of this increase. People felt incredibly rich on paper, so their behavior completely defied their flatlining paychecks but perfectly matched the booming valuation of their homes.
Economists tend to frame this through 2 competing theories. On one side, we have the Modigliani life cycle model. Under this theory, the middle class was actually acting perfectly rationally. They saw their housing wealth go up, assumed it was permanent, and extracted that equity to smooth out their consumption. Sounds reasonable, right? But on the other side, we have the Minsky moment. Hyman Minsky theorized that the seeds of vulnerability are sown in good times. When you have a massive debt boom fueled by perfectly rational individual borrowing against asset prices, it creates terrifying macroeconomic vulnerability. If those asset prices ever stop going up.
This takes us to Section 4, becoming the epicenter of fragility.
Treating temporary housing price bumps as a permanent replacement for actual income growth comes with devastating consequences. To quantify this extreme vulnerability, researchers ran stress tests on historical household data. They essentially asked, okay, what happens if these households experience a sudden income shock, like losing a job in a recession? The results are terrifying. From the 1950s to the 1970s, the total value of outstanding mortgage debt at risk if the middle class suffered an income shock increased by a staggering factor of 8, an 8-fold increase in financial fragility. No way around it. That is a massive red flag.
So the crucial point is this sobering finding from the Federal Reserve paper. Over 4 decades, the middle class fundamentally transitioned. They went from being the reliable anchor of economic stability to the absolute epicenter of financial risk. The entire banking sector was now incredibly exposed to the highly leveraged, fragile balance sheets of average citizens, whose wealth was built almost entirely on the shaky foundation of inflated house prices.
Finally, let's look at Section 5, a generational financial hangover. To bring all of this high-level macroeconomic data back down to earth for a second, we really have to look at the human aftermath. When the Minsky moment finally arrived in 2008, it didn't just break the banks. That grand wealth illusion suddenly vanished into thin air. Research from Syracuse University highlights this visceral shock perfectly. They note the value of home ownership decreased by approximately 30%, leaving the millennial generation uncertain about their financial futures. I mean, just imagine watching your family's entire net worth, built up over decades, evaporate by nearly a third, practically overnight.
Let's tie it all together. Roughly 90% of those in the middle of the income distribution had their wealth heavily concentrated in their houses. When that sudden 30% wipeout hit, it did way more than just destroy balance sheets. It caused severe psychological scarring. The parents' Minsky moment translated directly into deep financial trauma for their millennial children. Watching their parents face financial ruin because of complex debt and market crashes left an entire generation highly risk-averse, particularly when it comes to things like investing in the stock market.
We've seen how stagnant incomes, combined with the incredibly powerful illusion of housing wealth, drove a historic debt boom, a boom that fundamentally transformed the American middle class into a systemic economic risk. So I want to leave you with this lingering thought to ponder. If the middle class, the group we have historically relied upon to keep the economy steady, is no longer the anchor of stability, what does that actually mean for our capacity to weather the next great economic storm? Thank you so much for joining me on this explainer, and as always, keep questioning the data.